Hi, I'm Otto from ORATS. Before an earnings announcement, the options market makes an assumption about how much a stock is expected to move. That assumption is called the implied move. It comes from the price of options that expire right after earnings. If you look at the cost of buying both a call and a put at the money, a straddle, that total price reflects how much movement the market is pricing in. The more expensive the straddle, the larger the move the market expects. You'll see this number quoted everywhere: the implied move, the expected move. Sometimes it's referenced through the earnings IV curve. But here's an important detail most traders overlook. The straddle price is not just the earnings move. It also includes time value for the period after the earnings announcement, between the announcement and the option's expiration. So if you simply take the straddle price at face value, you are mixing two things together: the move expected from earnings and the value of time that still exists after earnings. ORATS uses a modified earnings-related distribution to separate the portion of the straddle price that reflects the earnings event from the portion that reflects ordinary time value after earnings. That gives you a cleaner implied move focused on the earnings event itself. But even then, one thing matters more than the number itself: context. That implied move is not a forecast, it's a price. And the only way to understand what that price means is to compare it to what actually happened in the past. To help you do that, ORATS shows the implied move and the average historical earnings move side by side for a specific stock. In the ORATS dashboard, the earnings tab lets you see this comparison quarter by quarter. You're not looking at a rule of thumb. You're looking at that stock's own earnings behavior. Sometimes the implied move lines up closely with history. Sometimes it's higher. Sometimes it's lower. A 5% implied move means something very different for a stock that typically moves 4% than it does for one that usually moves 8%. Without that comparison, you're reacting to a number without knowing what it represents. Another useful comparison is looking at how other stocks in the same sector are pricing earnings this season versus historically. That gives you a normalized reference point, not just the stock's own history, but how current expectations compare to sector conditions. ORATS also surfaces metrics like the average absolute earnings move and historical straddle prices as a percentage of stock price. That helps you see whether today's pricing is typical for that name or unusual relative to its own history. This isn't about predicting the next earnings move. It's about understanding expectations before you trade. When you can see what the options market is pricing and how that compares to historical behavior, you're making decisions with information instead of assumptions. If you want to explore this for any stock before earnings, you can find it at orats.com. I'm Otto. See you next time.